Hi there, everyone. Welcome to our webinar from MPC Markets, Hyperscaling AI. We will just start off now. Just going to do a little bit about MPC Markets for those of you who don't know us. So this MPC was started about two and a bit years ago by myself, Kai Chen, Jonathan Takadina. We're all ex-traders. We used to trade our own money for a living. And we sort of set out to build something that was in the best interest of investors, not run by salespeople, really. So we sort of noticed a trend in the broader market that that realistically the clients' needs weren't really being looked after, and we started something that we would want to use when we were traders back in the day. So our principles are investment solutions. We're very client first. We ask questions of our clients, what they want to invest in. This is what this webinar has come out of. We recently did a structured investment around this, a 2-year packaged investment, and which had very, very high demand. And so we thought we'd do a webinar on it, basically. So education is another priority. Help when you need it. So those down markets and things, we're always there, and quality at reasonable costs, and what you need to know when you need to know it. So not just bombarding you with constant trade recommendations, etc., when you aren't necessarily interested. So that's enough of the salesy stuff for now. Let's get into hyperscaling AI. So it really has been compared to an industrial revolution, essentially. And as you can see here, global artificial intelligence market through to 2030, you can see basically where it's going in. It's just exponential, the amount of investment that's going in there, software, hardware, services, etc. And one really interesting fact was, general office construction at the moment versus data center construction is, I think it was basically around about this month or last month, data center construction actually overtook general office. And so that's a very big sign of things to come overall. And, this is what this webinar is very much about today. I mean, everyone's heard of the Mag 7, the Microsofts, the Amazons, the Googles of the world, the Nvidias. We're looking at essentially today all of the fringe investments that you can get involved in that are still going to be facilitating this AI investment revolution or this industrial revolution, but probably the things that are a little bit, left of center that you hadn't really thought about yet, as yet. So here's what we're basically going to cover. So there's 4 key areas really. The bottom 2 are the same key area, but there's a little bit of geopolitics in there, and we've had a fairly differing sense of opinion in terms of clients that weren't very interested in the Asian hyperscalers, but were very much interested in the US. But it's well worth mentioning, because it really is, in the government's minds, both in China and the US, it's a point of national security, essentially. So the AI battle, and really we're I think if you want to invest across this whole thematic, you probably need to be involved in both, because the lead may go back and forth over the course of time. We saw what happened back in back a few months ago when DeepSeek came out, and Nvidia, to their share price, it caused a bit of a kerfuffle and a significant downturn. Alibaba's also in the last week announced a chip that they're releasing that will basically handle most of the tasks that Nvidia's H20 chip will. So it's definitely worthwhile looking at both, and just really basic things. I mean, the rapid expansion of data centers is going to be significant. As we just saw in that graphic from general office construction. So I mean, look out the window if you see how much office construction is going on, and just know that somewhere in the middle of nowhere there's just as many data centers, if not more, being built now. So those key resources we're going to need, wiring and copper particularly. cooling. And one thing that going down the rabbit hole on this topic particularly was how investable water actually is, particularly on US exchanges. There's ETFs, there's specific water companies, infrastructure and utilities, but also infrastructure as well. So it should be very good for the steel market and iron ore for the Australian markets. There is a lot of concrete and a lot of steel needed to build these things. A lot of insulation, etc., and cooling, particularly because the data centers don't tend to be, they don't tend to be in the middle of a city. They tend to be in the middle of nowhere, and they do tend to be in places where there isn't a lot of water. So there's some interesting ways you can invest in water there. Also, powering AI. Look, baseload electricity is a really big one. We're going to talk nuclear, but we're also going to talk some of the the non-ESG, like natural gas and coal, because renewables really, while they're still a little bit further away in terms of, you'll need battery storage on top, but you need reliable baseload electricity for these things. It's not the sort of thing that where you can have a situation like we had in Germany a couple of years ago, where they've spent the biggest on renewables. And they essentially ended up having to re-legalise coal because they had very overcast and non-windy conditions for a long period of time, and that wasn't feeding back into the grid. And you can't have your data centers being starved of power. It's not like it's an easy fix if you just to switch them off and back on again. So power management systems as well, and sensor technology. So there are a lot of fringe. These chips that NVIDIA is selling at the moment, they're, I think one unit's around about $150,000 US dollar mark. So, and then you're interconnecting these. There's also a 9-month waiting list. So, protection against power surges, against fire, against humidity, etc., and heat, obviously. So the sensors part is going to be, a very, very small cost for very expensive equipment. However, they are absolutely necessary, because even if you have the money to replace your high grade chips, there's still that waiting list. So let's go with the key resources first of all. Look, with wiring, copper in particular, there is really no other alternative for copper. Aluminium can be used, but it's very space hungry. So you can get the same connectivity with aluminium. However, realistically, that's going to be more so used in in your server cases, and probably within the construction. So aluminium will have an increase in demand, but probably nowhere near what copper will. Obviously, the power cables, bus bars, connectors, heat exchangers, power distribution strips, etc. The networking, not so much anymore. They're usually using fiber optic cables. And look, as well, having a look at water here at the moment, Google just now is, and these figures are probably 6 to 12 months old. They're using an incredible amount of water. So 9,500 Olympic pools in water consumption. And then you've got Microsoft is in second place there. Then Meta, Apple, and NVIDIA. But look, I would say a lot of the Google, Microsoft, and Meta would be spread in running those NVIDIA chips. So overall, there is a couple of ETFs in the US. PHO is one of them that you can invest in, which gets a broad base. We've got a couple of very stock specific. Unfortunately, there's nothing really in Australia you can do, but some interesting facts about water investment in the US is that the S&P Water Index has actually outperformed gold and energy sectors over the last 10 years. So, and this is obviously involved in water utilities, but water transport, water filtration, water technologies. So the filtration is particularly interesting, just on the basis that the water over time can become quite grey and essentially lose its ability to cool. So being able to effectively use a filtration system means that they can recycle the water over and over again. Without that, you get probably about a tenth of the use out of what what water gets shipped in. So and it really is. It's almost the same as power overall in terms of what it's going to add to the grid. So the cooling graphic just didn't quite work there, but refined copper demand, reshoring for AI, obviously you can see here from 2024 onwards is going to head back up. The US is actually fairly copper independent, essentially. So the recent tariffs that Trump's put on is more about bringing refined copper or refining process back to the US, and essentially they're actually a net exporter overall. So that really was more about bringing the refining back. It's not a bad policy from Trump overall, and I'm usually fairly critical about how he goes about things. But the main point of this is that there's going to be a massive uplift in demand overall, and if you end up with copper intersecting with apart from the energy transition, but if the Chinese property market starts to come good, then essentially we are going to have a supply gap in copper anyway. You've seen the likes of BHP and trying to take over Anglo American, Rio, really trying to lock down those copper resources, and essentially the battle for those things, because some of the biggest copper mines in the world are coming to end of mine life. They've been going for 30 or 40 years, so they essentially we need to find more. And because copper prices have been so low for so long, we're at $4.50 a pound. Very good buying there at the moment. You can do that via a number of ETFs. Just see if we can get that. We can't get that graphic up, unfortunately. And but yeah, so overall, that copper demand is going to hit some form of supply gap at some stage. Electric vehicles as well use a lot of copper, and that's why these major companies in the world are scrambling. And despite the fact being copper being quite low at the moment, I think that's probably one of the only opportunities as it stands at the moment. That is just an absolute lay down buy as it stands. So, and we're very lucky in Australia to have a bunch of different, copper companies from a resource point of view that we can invest in. So, but yeah, moving on to power now. So Google obviously uses the most amount of power. We're talking 2.3 million households here. So if you're adding all of these up, we're looking at a 6 million household sort of city essentially. So we're adding a city per and this is going to exponentially gather more steam. Basically, we did some calculations on the NVIDIA chips and how power hungry they are, and essentially NVIDIA, they're always in the smaller part here because they just design chips. They don't actually make them themselves. And TSMC does that for them in Taiwan, which is of a geopolitical risk within itself, but which is why Trump's been trying to onshore the chip makers back into the US. But this power really, if you're talking about 6 million or nearly 7 million households, you're probably talking 14 odd million people. So, and we're going to continue to add those. It's something, the NVIDIA chips that are due to be pushed out next year, it will add a small city around the size of Phoenix, apparently, was the last sort of soundbite stat that I heard. And then this is how much energy is used per $1 million earned. So, their megawatt hours per $1 million US, and the more money they make, the more they're going to, the more hungry they're going to be for power. Even Jensen from from NVIDIA said basically the only limitations to how AI is going to take off over the coming decade the limitation is essentially going to be power. So it won't necessarily be the chips and it won't necessarily be the software. It will definitely be the availability of power. So, I mean, even when we have very hot summers in California or in Australia even, there's rolling blackouts as it is just for air conditioners, let alone these things being plonked and running it and just absolutely consuming enormous amounts of power. So the push is really going to be for nuclear. In the meantime, natural gas is probably going to take up most of the shortfall. This is an infographic I grabbed. I don't necessarily agree with the renewables part. It does have an asterisk against it there. So this is where we are at 2025. So for all the coal investors out there, and I did get a couple of DMs from people saying, essentially, are you going to cover coal? I know it's unpopular, etc. But coal is just going to be part of the reality, unfortunately, more so in China than anywhere else. But it's still a reality in the US, and the US does have a lot of coal, but they also have a massive excess of natural gas. So where that Stargate project that they're looking at putting $600 billion into, in Texas, essentially there is excess natural gas that they're effectively burning off from oil, from drilling for oil, and look, nuclear very small here at the moment, but we've seen a number, I think nearly a dozen nuclear deals. Microsoft and Constellation have done a partnership whereby they've restarted an old nuclear power plant, and they've bought basically 20 years of forward electricity exclusively. So they've essentially just bought their own. And you've got to remember, the Mag 7 have been making so much money in the last decade or more, that they're rich. I think they rank as the 7th, 8th, 9th, 10th, and 11th richest countries in the world. They're sitting on massive stockpiles of cash. They're not going to let a little thing like power get in the way of them making money. So, and they obviously they can extrapolate this out because they're servicing billions of people globally. So, a little bit of power spend in one particular area does convert into millions of dollars for these guys. So, because they're selling to the whole world. So I look, by 2035, perhaps some renewables. Like as I said, I think if hydrogen technology potentially could be part of that, but the technology is not there yet. I would say these very optimistic numbers here in renewables will probably convert more so to natural gas and coal. So I think coal, and we've got a number of great coal companies here in Australia. We've got the world's cleanest coal as well. But I mean, look, there's a lot of coal around the world. The US and China, particularly the two largest nations here in this race for AI. So, and they've both got a lot of coal and a lot of natural gas. But nuclear really is the answer long term, and that'll be via small modular reactors, which the military already uses. So submarines and supercarriers, they can be out to sea for 40 to 80 odd years without coming in, only really for food. And shore leave for the sailors, to be honest. So, they're around about the size of a shipping container, or anywhere up to maybe 2 shipping container sizes. The big pushback, particularly in Australia, we're a little bit backward about nuclear in Australia, and overall, look, I think we'll start to catch up. We do have the world's largest deposits of uranium here. BHP is sitting on a lot in Olympic Dam. Their recent earnings report, actually, they mentioned it for the first time in a long time. It's actually just a byproduct of them mining copper in Olympic Dam. So, but they actually started to mention it. They probably would need uranium prices per pound above the 120 mark, I would say, and we're not really near that at the moment. But you've seen the likes of Cameco in Canada go through the roof this year. I think they're up around about 80% in the last 12 months or so. So that just adds another feather to BHP's bow. But these things are, but whilst they're available to the military, they're not commercially available. And commercially available small SMRs or small modular reactors are probably around about that 4-year mark away. We got a company in particular that we like is called Oklo, and they're listed in the US, and essentially they've done a while their technology is basically being progressed, they've got a Department of Defense contract, and they've been shortlisted in the US to receive government funding to progress their project. Essentially, they've teamed up very, very, very cleverly with Liberty Gas. So essentially, they'll roll out their software and their power management platforms across a bunch of data centers. Just the power will be coming from Liberty Gas in the meantime. So it's a smart move for Liberty Gas as well. Once nuclear comes online, I mean, these things will last for decades, essentially, before the energy's spent. So it's very dense, and uranium and nuclear, obviously, particularly. So but providing that natural gas, getting everyone ingrained in your platform. So essentially, all it is a switch at Oklo's end or Liberty Gas's end in 4 or 5 years' time when these small modular reactors come on board. Is going to be a massive advantage. So that's why we've really singled out that one in particular. There will be increasing uranium demand. I've been a fan of uranium and nuclear for some time. I think renewables, realistically, the likes of hydrogen, the lack of reliability for solar and for wind power as well, until the battery technology catches up and we can store that energy effectively. I think we governments particularly, and from pressure from their constituents, probably jumped the gun a little bit on renewables and promised a little bit more than what they could actually deliver. I mean, hydrogen will be a great source, but it'd be more industrial based. But it can be compressed and it can be shipped as well, like gas can. So, and obviously the only emission is water. So that's in an ideal world, but it is nowhere. I think it'd still be around the 500% more expensive than competing with natural gas or nuclear or oil. So with nuclear particularly, I don't think it's a uranium issue. It's more the infrastructure issues. So yeah, there's a couple of options there where you can get involved in the power side, and we might just I might just try and bring this and reset this just so we can see the graphic overall, and I'll represent. Where were we here? So we'll go. Excuse for the technical difficulties, everyone. So this is the nuclear fuel demand and capacity. So this is the 2050 nuclear power target. And what gigawatts capacity that they're looking for, and uranium feed that needs to come in. So the current enrichment capacity is, not much, essentially. And we're going to need more and more exponentially enriched uranium and uranium feed over the course of the next 25 odd years. So that's really not going to change. So I mean, you've got a couple of options. In terms of ETFs and uranium companies in Australia, Paladin's probably one of our favoured ones. BHP is probably the all-rounder overall, but one that we've been on Cameco for the last year. It hasn't had the volatility because it's a producer and is making money and already supplying to uranium to grids. So, but look, the likes of Paladin will be in about 4 or 5 years' time, with a recent acquisition, will be the third largest in the world. And that, the caveat being though, is that is realistically, if BHP doesn't come in, I think BHP sitting on the world's largest discovered deposit of uranium could pretty much blitz both of them. So, or all three of them really. And become one of the largest. So I think it's just being price sensitive, and it's for them really. They're already mining. They're already, like I said, as a byproduct. I think it's a price thing for them, and I do respect BHP's cost and discipline and fiscal discipline to not jump at this too quickly, because they do have a number of other things coming on, except potash, and they've obviously still got a lot of iron ore and copper, etc. So I think their immediate, despite the price being quite low, their immediate priority is copper for now. So now we're just going to move on to sensors and monitoring. So we need fire sensors, humidity, UPS monitoring. So if there's any power shortages, there needs to be battery packs in there. Rack vibration, not only for things that are within the rack, but obviously if there's any earthquakes, etc. Air conditioning, server monitoring, water leakage, power meters, temperature, etc. So there is a lot going on inside these data centers, and they don't generally, they're fairly unmanned. And I believe that a lot of these centers will be run by very few people in the long run, but which will make this the sensors and the monitoring even more important. So, I mean, we've seen the likes of John Deere have people sitting in an air-conditioned office controlling 4 tractors, or things like that. I mean, this is not a big step for centralized monitoring and sensors to be over multiple data centers to be rolled out overall. But it will make these sensors incredibly valuable in terms of being able to get ahead of a problem, because I dare say you're not going to have an enormous amount of staff there, that can respond very quickly. So you want to see these and get ahead of these problems early, and that's what all these sensors and monitoring will do. So, look, I mean, the rapid expansion of data centers, really, there's chip and chip design. You got all of these guys are designing their own chips. NVIDIA is the leader at the moment. Components and manufacturing, I mean, TSMC does pretty much, it's in the high 90s of high-grade chips. But they're really, I mean, Intel and Samsung do a little, but I mean, TSMC is one of the most remarkable organizations really in the world. The output of the amount of chips they output per day equals all of the other units of every other factory in the world combined, essentially. One thing that we are very focused on the chips for NVIDIA, but their networking and their ecosystem is becoming an extraordinarily big part of their business. And Jensen's even said in the most recent earnings call, essentially they really do aim for that to be probably the main source of revenue, in the future, because look, they've got a big lead here at the moment, but again, they only design chips. They don't actually make them. So there's not really a novel advantage there, particularly if someone, manages to design something and take over, or, if we have another DeepSeek moment, essentially, where software makes lessens the demand for high-grade chips, essentially. So at the moment, it's definitely at a chip-based point. But so you got down here power and thermal management. So Schneider Electric, Oklo Power Generation, GE Vernova, sorry, that's General Electric. They've got a small modular reactor part of their business as well, but you can't just buy that particular part of the business. So we prefer our pure plays, and overall, but Oklo's been one of the ones. But Vertiv is very much across the board in terms of sensors, and in terms of power management, cooling management, humidity management, etc., and a bunch of different platforms as well, whereby you can essentially monitor your entire ecosystem. So Oracle's done very well recently. Broadcom's probably the main contender. Micron is another recommendation we've had, in the memory section as well. And Marvell as well is one that we've had, we've had holdings in the past. You've obviously got Google Cloud, Microsoft, They're making their own custom chips for very specific things, whereas NVIDIA is a bit more of a blunt instrument, but a very highly powerful blunt instrument that can do everything overall. So what's pushing this is the cloud growth, essentially. Look, we're going to cloud AI market's going to grow at nearly 30% CAGR from now until 2032. That is an incredible amount of growth. Last year was 78 billion. This year's 100 billion. We're talking in 7 years' time, this being towards the 600 billion mark. Look, this is just North America alone. Is nearly 28 billion in 2024. So it's just going to increase demands, and as well, one thing that people don't necessarily think of is it's going to increase demand as well for cybersecurity, because everything is going to be in the cloud, and that cybersecurity sort of edge, or companies the likes of Palo Alto, Fortinet, Zscaler, etc., are going to get more and more demand, but not only from this, but from another very strong thematic in defense. So hyperscaling AI and defense are probably our two, not probably, they're definitely our two most high conviction thematics for the next couple of years. And if there is demand from people out there watching at the moment, I'm pretty happy to do one on defence in the next couple of weeks, a webinar on defence if the demand's out there for you guys. So just shoot us an email or drop us a line on social media. So the US hyperscalers, really, I mean, you've got your cloud foundations, your platforms. I mean, there's Palantir in there. That's, whilst it's an AI, it's very much defense-based. All your data platforms, Azure, which is Microsoft, AWS, which is Amazon, Google Cloud, then you've got Oracle, and then look, your software as a service and your end users here. Salesforce has been incredible in terms of rolling that stuff out. I think to the point where they've rolled out so much stuff, their clients are really only catching up to what's been there for quite some time. So they were an early spender. And ServiceNow is another one where you can do out of the box solutions for, at a massive corporate scale. And essentially you can, as a large corporate or even as a smaller business, you can buy, agentic units. So what I mean by agentic is so AI is going to graduate from just being able to type into GPT or Perplexity or Grok or etc. And essentially what the next stage will be, software will start doing things for you automatically. So Azure's been very good at that. Atlassian, as I said, ServiceNow, Salesforce, Workday, productivity for Microsoft and Google as well. So that's where they're making their money, and obviously they're vertically integrated, so they do go all the way back to these cloud platforms and compute, storage, etc. And but look, there's a number of different companies in there that will be beneficiaries overall. The likes, we're a little bit unlucky in Australia. One of my pet hates is when they refer to Appen as an AI company in Australia, whereas essentially the DALL-E software that's been out for over a year and a half now essentially does what Appen does via AI. So we're not very spoiled for choice in Australia unless you want to go into the ETFs, unfortunately. But in here we are with security as well. So CrowdStrike, Palo Alto, Otka, there's a number of names in there that you can have a look at. So we do really, there is a very broad scope of companies you can invest in, particularly in the US. Arista is another very good one on the networking front as well, which I don't think was in that graphic before. And look, here we go into China. So the Alibaba really is, I mean, it's the equivalent of the Amazon, essentially, of China. And you've also got Tencent with their ecosystem, but Alibaba is probably one of your best bets. I would say as broad exposure. You can't often get you may not be able to invest in a certain one in a certain amount of these. A lot, Alibaba, Tencent, etc. A lot of them are actually listed on US exchanges now. So we've owned Alibaba ADR a number of times, and we've done quite well. I think we hold it at the moment. We've done quite well out of it. That would be my sort of all-rounder pick. These ones here, I mean, you're really going into the weeds. ByteDance, and Diddy, like realistically, this one, Alibaba or Baba, is probably your best bet overall. As I say, as the all-rounder, they've got ecosystems in place. They've got a very broad reach. They're involved in data and the cloud computing and operating systems, etc. So, I mean, Tencent would probably be the second one. But again, I think we're favouring Baba here at the moment. They tend to trade at much lower multiples than the US as well. And I think the market was very taken by surprise when that DeepSeek. But China's Silicon Valley in Shenzhen is one of the most competitive, startup places in the world, and I don't think they can be ignored. I think you need to probably have some of this in your portfolio. So, and I just wanted to run through the investment cycle here. So what we've spoken about really is more about AI infrastructure, the people that are going to make the money now. But I wanted to just to go back. Obviously, we're probably in the computer age or a little bit further along. And the reason I haven't really mentioned any of the software vendors or the software providers, etc., is because if you have a look here, when the world went wild for personal computers, and then the internet came along, these guys, I mean, some of the biggest and most used like platforms didn't come along until 4 years after the dot-com bubble had burst, and then sort of recovered. So LinkedIn now owned by Microsoft. YouTube, I mean, a funny story about YouTube. Someone actually tried to start YouTube before broadband came along, and they went bust. And then essentially the difference was essentially bandwidth for internet lines. So someone's restarted, YouTube essentially, not necessarily stolen someone else's idea, but relaunched when that bandwidth came along. But I mean, look, Snapchat, Instagram, WhatsApp, not even until 2010. So we're talking a decade after. Uber, Airbnb. We didn't have the smartphone until 2007. Twitter didn't come along. I mean, MySpace is a thing of the past, but Facebook wasn't until 2005. So these sorts of software companies, really, we don't tend to make. We don't really tend to make too many predictive calls on. Mainly because, I mean, look here, Napster, I mean, eBay survived, Amazon survived, but only barely. Amazon wasn't profitable till 2009. America Online, I mean, these companies went by the wayside. So looking at that investment cycle, you probably don't want to be in that early thing, in those early software companies. So, but just to give you an idea, with the explosive growth of Gen AI, the software development, these are some of the companies that are out there at the moment. Not a lot of them are listed. I've got to say, GPT is not even listed. It's got to be been bought up by, and consumed by the bigger players. But look, this was more to show like visual generators, images, video, design, code, coding as well. Vibe coding's really taken off. I mean, what used to take 2 years really now takes months at a time. A lot of the coding's probably not going to be a job that really is going to be around in a few years. Albeit, not at the grunt working level. So, but text generators, voice, audio, music, etc. So, generative AI and these large language models are really going to be, whilst they're great, I think the good ones are just going to end up being taken over by these hyperscalers, and the rest will survive. So, won't really survive, and unless they're extraordinary, but I don't see that happening I don't see that phase coming in for the next couple of years. So this is how we're investing at the moment. So as you can see, ASX, unfortunately, and I know a lot of you are ASX investors out there, you don't have a lot of options, unfortunately. So we've got BHP, you got Global X, Wire is the copper ETF, which is just a US ETF called COPEX that has listed units here. GXAI, not bad, pure play and big data. AI infrastructure, also not bad, but a lot of stuff in there that I wouldn't normally, I wouldn't bother investing in. We'd much rather the single stock exposures, but with an ETF, they do have to provide diversity. So I get where they're coming from, but not really our flavour. Asia, there's also one called Dragon as well, which is China focused. But Asia includes China, but there's also the rest of Asia. And yeah, so but on the global side, so at MPC Markets, we do we're one of the only locally based global stock recommendation services. So we we sit up at night and place the orders for you, because obviously US markets don't open until 1 in the morning or 1:30 in the morning sometimes. But it really has been, since we made this available around about 9 months ago, a lot of our ASX clients have very much gravitated towards the global side. And look, in this, particularly in this thematic, there are a hell of a lot more options. You got Vertiv, which I spoke about before. Oklo on semi does sensors and cameras, etc. Ecolabs, our pick and water. They're the big names there. Oracle, Palo Alto. Not to mention TSMC, Alibaba. So we really piece together our own overall, and you can have a bit of a look, at our track record here. The global high conviction, I think there's around about 10 odd picks there. 90% win rate. These are since November last year. We started all these recommendation services, and our short-term alpha as well, which sometimes they're not short-term. Sometimes we will run things a little bit longer term, particularly in the global alpha. But the closed trades in the global alpha, which we started back in sort of late March, early April. So it does have some of those, the periods where it's gone down. But obviously there's been favourable conditions for this service overall, I've got to say. But there's only been one loss in the closed trades and 1 or 2 losses, I think. And the win rate's around the 88% mark. The open recs at the moment, the average profit's about 13, average negative is about 8, but they're 50-50 as it stands. But our total performance across all of our ASX, high conviction, short-term alpha, which is a lot of mining stocks, and a couple of other bits and pieces, but is around that, is 78% mark. So and our best performer in the high conviction is up around about 160%. The worst performer only being down 25. So we've very much outpaced the index by at least double on the ASX particularly, and the short-term alpha as well. The cumulative, if you've taken every recommendation, the cumulative is about 185% there. Not really comparable to the ASX, to be brutally honest, but look, that's over. There would have to be 50 plus recommendations out of this service, and we've got our new platform called MPC Mosaic. So essentially, the recommendations get pushed to your phone or pushed to your desktop. It's got all of your holdings. We will have a facility for those of you who want to be self-directed to upload your holdings coming towards the end of the year. You can message and chat with your broker directly, and that's one thing that we are big on here. We don't just throw a recommendation out there and you're just left with it on your own. We want you to really, we very much want you to be engaged with us, either via the content or via the chat. So you can chat with your broker. All of our news and content and our education, etc., as well gets pushed through that, and then. We're coming soon. We'll have do your own research, likely powered by TradingView, and we have our own AI as well, which is being trained on our own data. We use it in house, not quite customer ready as yet, but we get instant views on your company announcements, and that will be, at the moment we're just vetting those because every now and then it picks up the wrong stock, etc. But we haven't seen one of those in a while, but that'll be rolled out possibly, towards the end of this year as well. So, but their portfolio management and quarterly reviews comes part of the service as well. Risk management reports. We've helped people manage big positions or growth positions that have become large positions in their portfolio, like Pro Medicus, like WiseTech, etc., like Palantir, which was a recommendation of ours last year, which is extraordinary amount. So instead of just saying scale it back, we back from our trading days, essentially, we write you a little report on how to help you manage your larger positions, and then you get all the recommendations as well. So that's our services there, and it really is aimed at helping you, as I say, get what you need when you need it, and be alerted, and then not have to worry about reading through ridiculous amounts of pages of essentially almost having to be an equities analyst yourself. We feel our job is to help you make the most informed decisions, but in a one pager. I mean, it's almost we find that our recommendation service suits our clients because it's very practical and it's very actionable, and people get the point very quickly, and you're not just having to end up doing using. I mean, everyone's busy. We know it's not time consuming overall. So, and the education part as well, both one-on-one and through a very extensive education sections on the website as well. So, look, thank you. Hopefully, I've managed to keep it to the 45 minutes. Due to my lack of technological expertise, you're going to have to, any questions, you're going to have to email us at invest@mpcmarkets.com.au. For those of you who registered, we'll probably give you a call and get some feedback from you. But yeah, overall, it is going to be a massive theme over the coming years, and having access to global markets, and having someone help you guide you through that is going to be pretty essential overall, because a lot of research goes into the back end of this, and look, thank God for AI, because what used to take me 4 weeks now takes me 4 days. But there is a hell of a lot of information out there, and there's a hell of a lot of investment opportunities, and unfortunately, we on the ASX at the moment, this is not one of those themes that you can really reflect very well. So if you are interested in looking at our US service, obviously, in our time zone, we execute the orders for you overnight. There is some use there for you, so you don't have to sit up all night, and we manage the risk there for you as well. So, give us a call or email at invest@mpcmarkets.com.au again. But thanks a lot for joining us. I think if there's some interest, we'll probably do another webinar towards the end of the month on defence and defence spending, and where you can invest there. Probably be a few more ASX options then. So but thank you very much for listening today, and we'll speak again soon.